Hey, this is Justin from breakintocre.com, and in today's video, we're going to talk about how to calculate property taxes on a commercial real estate investment. Now, these can be some of the biggest expenses that you're going to see on a real estate income statement, and so getting these right is extremely important in your real estate investment analysis. So if you're doing any sort of real estate investment analysis, looking to buy a deal, or looking to work in the industry, make sure to stick around for this video. Now, if you're new here, on this channel, we talk about real estate investing careers, real estate investment analysis, and real estate financial modeling. So if you're looking to break into the industry for the first time, or you're looking to advance your current real estate investing career, make sure to subscribe and hit the notification bell. Now, when you buy and operate a commercial real estate property, property taxes are likely going to be your biggest expense line item on your cash flow statement. So getting this right is extremely important when you're making projections about the future income of your property, especially since commercial real estate assets are valued based on the operating income that they can generate. So in this video, what we're going to do is break down how to calculate property taxes in a 5-step process that you can use regardless of where you're located. So let's start with step number 1, and this is going to affect all the other steps in this process. And step number 1 is to determine whether or not your property value is going to be reassessed upon sale. So depending on where you're located, when you buy a property, that property might be reassessed for tax purposes. And what that means is that you, as the buyer of that property, may see a huge spike in total property tax payments once that reassessment comes into play. Now, this is especially relevant for properties that have not been sold in a very long time, and California is a really good example of this. So in California, it's not uncommon to see a property that hasn't traded for 30, 40, or even 50 years have a very, very low tax basis, and then when it actually sells, that tax basis goes up to 100% of the overall purchase price, and property taxes can increase 2, 3, 4 times of what they were on the historical cash flow statements for that previous owner. So this is really important information to know going into an acquisition, and it's generally very easy to find through a state website or a county website, or potentially even calling the county as well. Now from here, if you figured out that your property is going to be reassessed, step number 2 is going to be figuring out what that property is going to be reassessed at as a percentage of that sale price. So in some states like California, as we mentioned, that assessed value is going to be 100% of that purchase price. But in other states, that assessed value might be 80%, 60%, 40%, or even 10 to 20%, depending on the specific state that your property is located. So again, this is going to be a very important metric for you to know and make an educated assumption on. Brokers should be able to give you some sort of guidance on this, but again, going directly to the state or the city is going to be the way you're going to get the most accurate assumption that you can. Now, once you've calculated what your assessed value of your property is likely to be, the next step of this is going to be figuring out what your millage rate or property tax rate is going to be. Now, oftentimes it's the case that this assessed value ends up balancing out, meaning that if you have a property that's going to be reassessed at 100% of sale price, that property tax rate might be something between 1 and 1.25%. But if you have a property that's reassessed at 40% of the overall sale value, likely you're going to see that millage rate jump anywhere from 3 to 4%, which means that this generally all balances out at the end of the day. So now from here, you know if your property is going to be reassessed upon sale, you know how much of that sale price is actually going to be assessed, and you know the millage rate that's going to give you your overall property taxes on the deal. That said, to make up your total property tax number, there's going to be one more step to this, and that is step number 4, which is figuring out what your fixed charge assessments are going to be. Now, your fixed charge assessments are going to be assessments over and above what you've calculated by taking that assessed value and multiplying that by the millage rate. And these are called fixed charge assessments because they're not directly related to that assessed value. So these may be fixed charge assessments to pay for local schools, fire departments, water and sewer, and other things that are going to be either on a per unit basis for a multifamily deal, or maybe a per square foot or per building fixed charge assessment for a commercial deal. So once you have your total property taxes and you've added in your fixed charge assessments, You've calculated your total property tax burden if your property is going to be reassessed upon sale. Now, if you happen to be in an area where your property value is not going to be reassessed upon sale, this leads me to step number 5, which is assuming some sort of an annual property tax growth rate. Now, some states will have a cap on their annual growth rates. So, thanks to Proposition 117 in Arizona, for example, the annual cap on property taxes is 5% per year, and you'll generally see 5% increases on property taxes every year in Arizona, and these property taxes aren't reset upon sale. That said, in a state like California that does reassess property taxes upon sale, the cap on property tax increases from year to year is 2%. So again, just know the rules in the area that you are investing in, and if the property is not reassessed upon sale, make sure you're adding that growth rate to your first year of operating expense assumptions, and if the property is reassessed upon sale, make sure you're applying that growth rate every year throughout your entire assumed hold period. So that's really the 5-step process to calculating what your property taxes might be when you're going to analyze a deal. Now, a really important thing to note here is to make sure that you remember to do this on the back end when you're doing your analysis and assuming what you can sell that property for. Because again, if you're looking at a property that is going to be reassessed upon sale and you're assuming that the next buyer is going to pay a certain amount of money to acquire the property, well, they're going to have a different property tax assessment based on the value of the property at that time if the property is reassessed upon sale. So make sure you're doing this analysis both for your acquisition and also in calculating what your sale value or exit value might be in a real estate financial model. So I hope that was helpful. If you want to learn how to actually build this in Excel and how to integrate this into a real live real estate financial model, make sure to check out the Real Estate Pro Forma Modeling Masterclass. I'll link that in the description below. And as always, if you want access to all Breaking the CRE courses, all Breaking the CRE models, and some additional one-on-one support, check out Breaking the CRE Academy, and I'll link that in the description as well. All right, so that's it. I hope that was helpful. If you like this video and want to see more content like this, make sure to let me know by hitting that like button, subscribe to the channel, and share this with anyone else who might find this helpful. Thanks so much for watching, and I'll see you in the next video.